Everyone. Welcome to tonight's virtual $1 trillion mixer here with Quest Trust Company. I am super excited to have our guest speaker with us tonight, Mr. Kenneth Wolfe, joining us from Dallas, Texas, here to talk about some different multifamily investments he's done recently, anything from A class to D class. So I hope you guys are excited for the presentation. But before we get started, I do just have a couple of quick announcements for you guys. For those of you who don't know me, my name is Haley Gant. I'm one of our certified IRA specialists here with Quest, and I basically work very closely with the rest of our marketing team to help to put on all of these events and webinars for all of you guys out there. So I do just have a couple of quick announcements kind of about Quest, who we are, how we can help you, and some of our different upcoming events here as well. So quick commercial about Quest. If it's your first time joining us, first of all, welcome. Super happy to have you here. We are a self-directed IRA custodian. We're based out of Houston, Texas, but we do have clients all across the US, and we do operate in all 50 states. So what makes Quest different from other IRA custodians is we actually teach investors how to invest their IRAs into non-traditional assets. So where most Americans have their retirement invested into stocks and other types of publicly traded assets, at Quest, we teach our clients how to invest their IRAs into real estate, notes, private placement investments. You really have a lot of options, and there's a lot of great ways that you can apply your investment knowledge that you have to your IRA investments and grow a lot of wealth, either tax deferred or completely tax free. Now, kind of moving on with this slide here, we do hold about $2 billion in assets under management. And the reason why we like to include that in here is because all of that $2 billion is all privately held assets that our clients choose to hold in their IRA accounts. So kind of gives you a lot of freedom. There's a lot of people doing this, but most people really have no idea that you can self-direct an IRA. So we are very passionate about teaching about IRAs. But please be aware of our disclaimer here. This is very important. Please be aware that Quest does not give tax, legal, or investment advice. We provide a lot of education when it comes to self-directed IRAs. We bring in a lot of different guest speakers to our events to kind of provide a wide variety of education. But please be aware that it is so important to make sure that you use professionals to structure your deals. Quest is here to fund the transaction. So you want to make sure that you are doing your own due diligence on your end and that you're not rushing into investments and you're really taking the time to make sure that you are doing the right due diligence and structuring your deals properly. Now that that is out of the way, a couple of quick announcements here for you guys. The tax filing deadline is quickly coming up on May 17th. So it was actually extended this year. Normally, the tax filing deadline has already passed here in April. But this is important because you actually still have up until May 17th to max out almost all of your 2020 contributions. And I know from year to year, overall, the contribution limits are not that large. But it's really important that you at least get an IRA open, at least start getting contributions in there and learn about the different ways that you can invest those funds. And one statistic that I kind of like to throw in here is if you open up an IRA when you are 25 years old and you only contribute $6,000 a year, and then the account only grows by 5%. If you do that every single year, by the time you are 70 years old, you will have just over $1 million saved up in that retirement account. And if you're doing this in a Roth IRA, all of that money is yours. It's completely tax-free. So give us a call or be sure to take note of our contact information here at the end of these slides. We have a lot of resources to help you get started. We can do a free consultation with you and just kind of help to point you in the right direction, let you know what your options are. And, at Quest, we don't sell investments. We're really here to provide education. And if it's a good fit for you, we will help to facilitate your IRA from there and, help make it a smooth and easy process on you. Now, this is just one of many events that we host here at Quest. We have a lot of education. Almost all of it is free. We have an online education center on our website, and we also have a really awesome YouTube channel. Big shout out to Nicole Faniff, you actually see right here on one of these little thumbnails. She is the mastermind behind our YouTube channel. All of our webinars are there. We record other educational videos every single week. So if you guys have not yet, be sure to subscribe to us on YouTube. It's been a really awesome adventure to grow that this year, and there's a lot of great information on there. We also host a lot of webinars. We bring in a lot of different guest speakers. We have self-directed IRA Saturday webinars, and you can find all of this on our website. If you guys actually look in the chat, I do actually have one of our other IRA specialists in our marketing department here online with us moderating tonight's event. Be sure to check out the links that she is sending. We have a lot of great resources for you, and there's a lot of different ways that you can apply this different education that we offer to help you build more wealth. Now, be sure to join us also for the virtual networking happy hours. These are a lot of fun. I host them myself. They are the first and third Wednesday of every single month. And it's actually set up as a Zoom meeting. So everyone that's there gets to share their cameras. We all have a drink together, and everyone gets about a minute to introduce themselves to the group. And at almost every single happy hour, we have had close to 50 investors from across the US. It's created a really nice kind of like network of us, and it's been really fun to grow those events. So be sure to check these out. They're all available on our website. And we also send out a weekly newsletter as well, where it makes it really easy to RSVP for all of these events. Now, if my slide about IRA contributions got you excited, or if you are looking to get started with an IRA here at Quest, we have a promotion going through the end of this month, which is just a few days away. It actually ends at the end of this week. But when you open up an IRA, we will actually give you a $125 credit that will cover your first transaction. So that's a really great promotion. It goes through the end of this month, and it is April 28th. So be sure to reach out to us. I'll have our contact information here on the next slide after this one. This is our next big event that we will be hosting, the July Summer Intensive. It'll be a 3-day course, 3 Fridays in a row, all online. And this is going to be a high-level event. This is not going to be the event where you hear about the basics of different types of investments. We are going to bring out speakers to talk about real case studies, due diligence, things you should be considering. And at the end of each day, we'll also give a short presentation on how you can apply all of the investment strategies you just learned to your self-directed IRA. So I'm really excited for this event. It will be a paid event. It's $25 to attend all 3 days. You get the recordings, and be sure to join us for that. And I'm excited. It's our first event of this style over multiple weeks, and we're excited to be hosting it for you guys. So this is all I have for my quick announcements tonight. Thank you guys to everyone for joining us. If you have questions, let us know. We are always happy to answer them for you. If you want to scan the QR code, you can actually schedule a consultation with an IRA specialist. Very easily, takes about 15 seconds. We'll give you a call tomorrow. Or if you just have questions throughout the day, visit our website. We have a live chat feature. And whenever you chat with us on the website, you are actually talking with an IRA specialist. It's actually us there. It's not a robot. So if you guys log on certain days, you might even get me on the chat. So that's all I have for you guys. Let me stop sharing my screen really quick. Without further ado, I would like to go ahead and bring on and introduce Kenny Wolfe, joining us from Dallas, Texas tonight. And I'm excited to hear your presentation. We kind of talked a little bit before the class got started, but go ahead and take it away, and I'll come back on at the end, and we'll do some Q&A.
Awesome. All right. Thanks, Haley. Guys, let me get this share screen again up here. There we go. All right. So I wanted to thank everybody for joining us, spending their time with us on a Wednesday night. I absolutely appreciate that. And then a big thanks to Quest, Haley, and all the Quest crew for hosting us again on this platform. So again, thank you all very much. All right. So tonight we are going to jump into and talk about our multifamily investing that we do here. We do four different real estate offering types, but we cut our teeth in multifamily investing. So I started buying multifamily properties over 10 years ago, grew our company, Wolfe Investments, to where it is today. But as you can see here tonight, we're talking about two assets that we bought within 10 days of each other. And they couldn't be farther from each other, and distance-wise, and an actual finish out and a class of property. So without any more, we'll just jump right in. So a little bit about us, about here at Wolfe Investments. Again, I started the company in 2010. And focused on the multifamily side. So since then, we've had over $250 million in acquisitions. Those are spread over 5 states in multifamily. And to date, we've closed on 77 units to date, with quite a big of a off-market pipeline of properties that are coming out here pretty soon. So anyways, we got, that's our multifamily side. And then about 4 years ago, I started a triple net fund, our first one in 2017. Those numbers are actually low. We're actually up to 24 stores, bought our first Walgreens and then a Rite Aid. We're putting under contract tomorrow. So that number is low on transactions too. So we're probably more about 30 million there. And then around the same time, just to kind of round out the types of real estate offerings that we do, I bought some townhome lots myself, not knowing development from anything, fleshed it out, built the team up. So now we do both ground up multifamily developments. We've got 2 projects going on right now, and one in Dallas, Fort Worth, and one in Cleveland, Ohio. And then kind of what may put us on the national map somewhat is that we bought the Rockefeller building. It's a historic office building in downtown Cleveland, bought that last year, and we're going to convert it to A-class multifamily. So that falls underneath our development arm there too. We're seeing a lot of activity in the office conversion space on our side. So we're excited about that new type of development deal that we're doing here at Wolfe Investments. But today we're talking about multifamily, so let's stick there. All right, so what's the difference? A-class. A-class, some folks kind of peg A-class on date. I think that's a bad way to do that. So these are kind of the markers or characteristics of an A-class that we use here at Wolfe Investments. So obviously this is the highest classification of multifamily properties. This is what you would, want to live in. It's a highly desirable place to live, prime location, top class amenities, and less operational risk due to high quality residents. As well, we noticed that throughout 2020 is that our as you slid up the scale in asset quality on the multifamily side, we had less and less, almost none issues due to COVID and evictions and all that, and lack of paying rent on our A-class properties. And then typically they have stable cash flow because they are more stable and have less operational risk. So on the flip side, D-class, this is the lowest classification. A lot of folks that do what we do don't really admit they buy D-class, but we definitely are proud to say we buy D-class. I've done this a few times, but and really because it's a big we get a lot of joy and excitement of doing projects like this, because initially when we buy it, it's a less desirable place to live for residents, run down, it's poorly operated. You just feel bad for the residents living there that are having to live there and not taken care of. They have limited amenities. I walked one the other day. It looked like it was a really old wooden playground. It looked like if you just looked at it, you would get splinters. But there is more operational risk, because what you're going to have to do is some of those residents are going to be able to stay and pay the higher rents that you need to get because of all the capital you're going to inject into the project. But there's a lot of folks that aren't going to be able to cut it, and you're also going to be getting out usually some unsavory characters, which I've got lots of stories about that. But they do have more upside potential. So we're buying these properties low, putting a lot of capital into them, and then taking it from a D to a B class is what we aim for. So there you go. So I'll just kind of talk about these properties real quick. So we bought the 400 North Irvay Apartments. It's also, the cooler name is the Post Office Building in downtown Dallas. It's a historic building built in 1930. It's mostly multifamily, but a little bit of mixed use in there. So it's 78 A-class multifamily properties, multifamily units. This was our first asset with real wood floors. So that's pretty cool. And then it's also got 5,000 square feet of office, as a local family office that's there through 2026. There's a deli, and then we actually do a profit share with an event space there where pre-COVID, we would get about 52 couples a year getting married at this event. So it is that pretty. The historical nature behind it, for those interested, it used to be the Dallas County Courthouse. So in 1930, that meant Bonnie and Clyde's warrants were served out of that courtroom. Which is still there today. That was part of the historical preservation that was done on the property. And in that courtroom as well, you had the Bonnie and Clyde harboring trials. Roe v. Wade was first heard in that courtroom as well, big landmark case. And then the judge, Sarah Hughes, who presided in that courtroom, she was the one who swore in LBJ after the JFK assassination. So lots of interesting history in the building. It's absolutely beautiful, and they did a great job doing the historical renovation on that asset back in 2012. All right, the appreciation play. There you go. One on the right. That is Maureen Street Apartments in Wichita Falls, Texas. It is definitely a D class. It was funny when we bought it. The seller told us it was 30% occupied. But I drove up like the day before, and it was highly occupied at 7:30 in the morning, or at least the parking lot was. So we've got a lot of non-payers there in the asset, so we're doing that kind of stuff. But this one's going to get a major facelift, brand new windows. We're going to change that the mansard roof to a hardy plank mansard roof. You can only fix ugly so much, but we're going to do that. It really does make a big change to the asset. New ACs, new roof. I mean, just new all the way throughout. So it's going to be a big transformation, and we're excited to be able to share some video and stuff down the road when we can see the big before and after reveal on that one. All right, so because I'm an economics major, I felt like I had to put a graph in here. So hang with me for there's only two. On an appreciation, you can see there on a Class D, it's going to have that you're going for that higher appreciation. Usually, on our deals, we're trying to get about a 70 to 80% equity gain in 2 to 3 years on these D class high value add deals. Class A, you can see there that it's going to have a lower appreciation, obviously, right off the bat, but over time, you're going to still get some appreciation through rent growth and some levers we can pull to increase our net operating income on there as well. Then on the flip side, you've got cash flow. So typically, this is what we see. Class D is going to have 0 or maybe negative cash flow, and then it's going to be kind of that hockey stick as it climbs back up as we do the rehab. Get residents in there at the higher rents that we're offering a better service and better property for them to go. So we usually see no cash flow for the first 1 to 2 years on these big fixer uppers that we do. But then year 2 or 3, we do some kind of capital event. And if it's a market as hot as now, we're actually selling 3 this year right now because it just makes sense. We're making 120 to 150% return in 2 years. And that was through a global pandemic on some of these fixer uppers that we did. So we've decided to sell those 3. But another option would be also to do cash out refi. We pull out probably 50, 60, 70% of initial equity to investors, and they hold it long-term for cash flow and tax shield. But sometimes, when New York City buyers call you, you got to sell. And then you can see there on the Class A, we show pretty much a straight line. It'll wiggle a little bit because it's multifamily, right? There is a little bit of operational risk, but you have a lot less on the Class A. People tend to prepay their rent on our Class A properties, and there's a lot less chasing rent as well. And this particular asset, the post office building, basically had a complete gut job, and so all the systems are new plumbing, new AC, new windows. I mean, all that kind of stuff is all shored up. So the operating systems on a Class A are typically a lot better. So it's going to cost you a little bit less, and you're going to have less surprises like you do on a Class D sometimes. So, we get this question a lot, what should I invest in? I love when investors ask me that. And my response is always, well, what do you want? It's because everybody's so different and their goals for their financial plan, if they have one, they should have one. You should definitely have one. Financial plan, what does that look like? Are you trying to retire sooner than later? Then you probably need to focus on cash flow. But if you're looking to really grow that nest egg quickly, and then go to cash flow, well, then appreciation might be the better option for you. So, always look at that. But cash flow obviously is we're looking to create passive income today. And then basically just allowing the market to do the work of getting some appreciation over the longer hold period. And then typically, yes, they're more stable. And there's typically less risk, and you got to put typically in there. But on the appreciation side, you're looking to really create quick equity and grow that nest egg quickly so you can compound your returns, right? That's the name of the game on that one. And because we are in multifamily, we have a lot of control over the appreciation because it's all numbers based, right? So I've got a background in accounting. It's what I did in my prior life in oil and gas. But we're able to use that net income, that T12 income statement, to really drive the appreciation through, increasing revenue, making sure our expenses are efficient, and running a lean and mean operation. So, but typically they are less stable at first. So you've got to be a little bit patient on the operation side, and you've got to really manage the rehab process well, because you're looking at big dollars you're spending on each unit. So you've got to make sure you've got a great construction crew that you know and work with. All right, so let's jump into some of these to these two. And like Haley said, I think there's a chat box down there. So if you have any questions, start teeing them up, and Haley will throw them at me. So this is we'll start with the DClass first. It's kind of hiding the screen there, but it's more Range Street apartments. The investment term is going to be roughly 5 years. That's what we kind of project on these. It could be sooner if we get a huge offer from a buyer looking to buy a stable asset there in Wichita Falls. You can see the annual cash on cash. Now that's after we stabilize it. So you're looking at a high number there, but again, you're not going to get much in years 1 or 2 on this asset until we do our rehab, until we lease it up at the higher rents. And you can see the 5-year total ROI. It's blocked for me, so I'm saying it from memory, but I think it's 123%, somewhere around there. Correct me if I'm wrong, but anyway, but this is the property. Look at that picture. Their slogan is "A place to build memories," and it doesn't tell you what kind of memories are being made there, but anyways, that sign's going to be hung up somewhere, probably in our office here, as a reminder. But it is the ugliest property on the block. But that's the point. We're buying this asset. It sits right next to an elementary school, right across the street from a high school. And then to the east and north, you've got, I'd say, about B-class single family. So this is the eyesore in that submarket. So we're going in, going to be the heroes of this section of Wichita Falls, but it's going to be a massive transformation from a D-class to a B-class. And we do kind of like Quested in the throes of COVID. We started a YouTube channel. So we started doing these property tour videos. They're out there on YouTube. Just type Kenny Wolfe in there, it'll come right up. But anyways, we're looking to this will be a really fun one for everybody to see the big before and after on that. But again, by creating a property where good memories can be made, will create value not only for the current residents, the prospective residents, the new ones that are going to be moving in, definitely the surrounding community as it borders that elementary school, and our investors as well. So this is another kind of feel-good project in Wolfe Investments. We did a similar one up in Denton, Texas, and that one we were thanked, I think, 2 or 3 times by the Denton Police Department for cleaning that one up and not having the phone calls about that property go way down. And then also we had some single family folks that were next to it, and they also thanked us as well. So this is one of those kind of feel-good, touchy-feely kind of deals where we go in and really kind of make a positive impact on the area through our investment. So you can see kind of the timeline here that we're looking at, or that this is one of the slides in our investment summary that our investors see in our portal. But you can see it right here. So 0 to 6 months, obviously we acquired the property a few months ago now. And then we're diving right into the major renovations. So the roofs, the paint, unit interiors. We already had all the vendors lined up. And ready to go. So we're able to jump real quick into the rehab. It's a complete exterior. So we'll complete the exterior rehab around 6 to 12 months. Obviously, now we're in the summer, getting to summertime around here with less rain, less cold, so we can knock out the paint and the windows and all those items pretty quickly. And we'll obviously continue the interior upgrades and push rents on renewals to match the market rent. So kind of a cool trick that we do, don't call it a trick, I guess, but a cool tool that we use is if we do have, once we get a handful of these new upgraded units done and complete, we have an open house for the on-site residents. And then if they want to transfer to a new one, obviously we waive their transfer fees, move them in at the market rate for those. And then what that does is it speeds up our rehab process. So we can obviously take their unit that they're moving out of and upgrade that one. So it really kind of speeds up our rehab on the asset and get more of those unit interior upgrades done faster. Around month 12 to 18, we believe we're going to have some stable operations there as well, and just continue to ride the wave of rising rents with some. It says small incremental gains there, but with inflation coming here really soon, I think we're going to have some pretty big gains on the rents kind of across the board, across the portfolio. And then around month 24 to 30, obviously once we hit stabilization, we'll kind of look to see if it's better for the investors to either refinance the property, pull some cash out, hold it for long-term for cash flow, or if the market is as hot as it is today, and we're selling these below 5 caps, B and C class assets, then to out-of-state buyers, then maybe time to sell. But anyways, we kind of weigh the options on these and see what's best for the investors. Here's again, another slide from our investment summary. It kind of walks people through what a $100,000 investment would look like. It breaks it down to cash flow, retained equity, return on capital. So this one, obviously we showed zeros across the board in year one because it is such a heavy lift. And we have a lot of people not paying rent. So it's going to be very vacant very soon on that. But again, we showed cash flow hitting about that 10.9% in year two. And that's partly because we have an interest-only loan for the first 3 years on there as well. And we believe we'll be cash flowing pretty nicely by year two. Retained equity, that's a good, everybody asked me about that, but that's made up of two things. Principal pay down. So in this one, there's no principal pay down because it's interest only, but the other piece to it is that the retained equity is made up of appreciation. So where we force that NOI to go up through higher rents and better operations on site. And then obviously return of capital is zero first 2 years. And that happens when we do a refinance. So again, year three, this is what we showed as what we projected to be the stabilization. Obviously, our goal is to do it faster than that. But at stabilization, we're looking at another 12.6% cash on cash return, retained equity of $34,000. Again, it's interest only, so that is appreciation. And then doing the cash out refi in year three, pulling about 37% out to investors. On this asset is the projected numbers as it was to our group. All right, let's go to the pretty one, So this is technically called 400 North Irvay. That is the address in Dallas. So if you get bored sometime, Google it or go to Wikipedia. It's got its own Wikipedia page, so it's bragging rights. But it's a beautiful asset. I get goosebumps every time I walk in the building. It's absolutely beautiful. It's a really cool deal. So the post office still owns 18% of the building. We bought the other 82%. It's got a rooftop deck on floor 6, which is amazing. That's part of the wedding venue or the venue event center there as well, the courtrooms and the rooftop deck. But we do think this is going to be a little bit longer term hold. It is just an amazing asset. It's irreplaceable located. You can see the train tracks right on the Dart line. So it's right there in the heart of downtown Dallas. You can see the annual cash on cash, 8.05%, but that's basically right off the bat. is we'll see that. And we're still doubling the investors' money by year 5, just beating that at 102%. And this one is the best looking property on the block, but that's the point. So again, we're buying this one for cash flow. It's stable, it's fixed up. The business plan behind it, because we bought it at a 5.5 cap, is their expenses were almost 3 times as high as it usually takes us to run our other A-class properties. So what we did on our underwriting is basically made no increase on revenue on rents, which their rents are low too, and there's other revenue items that they're low on. But we just assume keep those flat in our underwriting just to be conservative. We cut expenses down to $12,000 per unit per year, which is still double what we usually run our other A-class properties in Dallas-Fort Worth at. And then combining that small fines and efficiencies, that with a HUD loan, which is a 35-year amortized loan, we're still seeing interest rates about 2.5, 2.6% fixed for 10 years. So by marrying those, making the expenses more efficient and that longer-term HUD loan, the 35-year amortization, that makes it perform almost like a B class. I mean, typically, these kind of properties, it's mostly an institutional buyer, and they're not hitting that double your money in 5 years, which is always our goal here at a minimum at Wolfe Investments. And then there you can go see, I already kind of talked to deal on point number 2. And then this is one of those assets that, this is our second historical asset that we own. But I'm a big historian buff myself, so it's just an honor to be a steward, one of the few stewards of this building in the heart of downtown Dallas. And it's just a joy to be a part of owning this deal and operating it better and bringing better service to the residents now. And then also making some pretty great gains for our investors as well. Again, there you go. You can see the timeline. Obviously, we already acquired the property. Improved expenses day 1. I mean, one of the easy low-hanging fruit deals is that they never protested the property taxes. So our purchase price was below the current value on the tax roll. So we've already got that protest going right now. They had they had too much staff. They outsourced cleaning crew. I mean, there's all this stuff where we were able to make this more efficient. I should also add that we have an in-house management company as well. So we manage these properties along with third-party folks as well. So we've got about 5,000 units that we manage currently underneath that company. But they do a great job. So having that in-house is a huge tool and a way to kind of really reduce your risk as an investor. But again, it's stable operational from revenue day 1. When we bought it, first day we walk in, there's only 2 vacant units. Within a week, we leased the second one, or the one of the 2, and so the one more to lease. So if you guys want a penthouse in downtown Dallas, let me know. You have your own rooftop deck. It's pretty cool. Anyway, and then cash flow distributions going to be right around start cash flowing to investors around month 4 to 6. We always say 4 to 6 to give us about a 2-month buffer. Then we'll go to the cash out refi to the HUD loan around month 6 to 9. It's HUD. It's they move very slow. So we're kind of told our investors, bank on the 9 months, but we'll push it and try to get 6 months out of them. But what's cool about that HUD loan, it's going to return about 15% of the initial equity back to investors, which is pretty cool, just 6 to 9 months. So there you go. So that's the timeline there in the post office building. This kind of runs you through the investment sample there at 100K. You can see it's just kind of that instant cash flow. It's just strong, steady growth there. Retained equity, we're going to have a big pop in years 1 and 2. We have interest-only loans right now on the bridge loan that we bought it with, and then for HUD, we expect to have no interest only, but the 35-year amortization is a big help on our cash flow, but it lowers the amount of principal we're paying every month. And then again, you can see there about a 14% return of capital we're seeing right around month 9 once we complete that HUD refinance. All right, so let's compare. If you invested in the Maureen Street apartments, it's going to take you a few years for you to see any return of capital. or cash flow because of the time needed to rehab and stabilize the property. But on paper, you're going to see quick, massive equity gain, which obviously, if you do it right, we either do a cash out refi and you pull up money tax free, you can reinvest that with us or whoever, invest in something, but it really snowballs your investment holdings. Or if you sell it, move it to a new investment and keep that compound interest really moving as well. If you invest in Florida North Irvay, you're looking for cash flow positive day one, quick refinance to get some of your initial cash back around that month 9. And like I said, cash flow to investors right around month 4 to 6. We'll start those and do those regularly. Appreciation is going to take a little bit longer. We'll get a good little pop there by making the expenses more efficient, but it's going to take a little bit longer to appreciate. But I fully expect downtown living to continue to be highly attractive to young professionals as well. So I expect rents to keep growing, especially here in Dallas, Fort Worth. We've got tons of folks moving to the city every day. So we expect our rents to keep growing strong. All right. So again, when you're looking at an A class or a D class to invest in as a passive, what are you looking for? You've got to figure out what your timeline for your financial goals and dreams are. If you need cash flow sooner than later, then, maybe go into the cash flow rights for you. If you don't need cash flow now and you're looking to really kind of beef up your nest egg, then maybe more of the appreciation model is for you as well. And I should also say we do have properties kind of in between these two as well. So B and C value add, we still find those from time to time off market, but anyway, so these were just kind of to get you two polar opposites, snapshots of these. And then, each asset offering type that we offer here at Wolfe Investments meets a financial need. And that's why we rolled them out, right? So multifamily is great on cash flow and appreciation. But there is some operational risk, right? But it's got phenomenal tax benefits as well. So, if you take some of our others and mix them in, and they're, obviously the triple net is more for stable, steady, boring cash flow. We don't get as much tax benefit there. And then the development properties, zero cash flow for two years or so until we lease it up, complete the rehab and lease it up. And then at that point we'd have a tax benefit on there most likely. So unless it all changes. Anyways, but at the end of the day, life is what you design it to be. So be proactive, figure out what your financial goals are, sit down with your significant other, and design your life. Always talk about create a plan and just go do it. So really that's it, guys. That's a kind of a way to connect with us there. There's our website, wolfe-investments.com. If you want to get in our email list to kind of keep up with us, see what we're doing, hit that big red subscribe button there on the homepage. Check us out. And then also we're pretty active on social media, somewhat on LinkedIn and a lot on YouTube. So again, check us out. We've got a lot of educational videos on YouTube as well, and some property tour videos that kind of do a dive into what some of our investments look like.
Awesome, Kenny. Well, I personally really liked that comparison. That was really cool to see the differences between such a nice apartment building versus one that's maybe not so nice, We do have a few questions here from the audience, and I actually have maybe one or two myself. One of our attendees wants to know for Irvay, how many doors was that and what was the price per door?
That's a very good question. So it's 78 multifamily units, and to not give the county too much leverage with us, we had to strip out. If you strip out some of the office and the deli and the event center out of the NOI, we paid about $175 a door.
Mm-hmm. Nice. Awesome. And we have a lot of people asking this question. And, guys, obviously we're here to provide education. We're not here to pitch investments or anything like that. But just so people can get an idea of the structure, do people have to be accredited to invest into these deals? How does that work?
Sure, no, it's a good question. So we do 506Bs, so we have to have some kind of relationship. So again, that's why we feed you guys through the website. Hit the subscribe button. You can set up a call, a meeting with me, and then we can get you in our portal. And then we always do 506Bs, so we take both sophisticated and accredited investors. We did one 506C, and I swore it off, never again. One won't do that. I didn't like it. And neither did our investors, to be honest with you. It's a big pain. So anyway, so 506B is what we do. We're able to grow just as much as we want to by doing those. So that's our typical SEC structure.
Mm-hmm. Nice. Awesome. Always such a popular question at the end of these presentations, especially with multifamily. Let's see. This is a good question here. One of our attendees wants to know if part of the definition for D class is dependent on the area, how do you raise it to B if it is still in a bad area?
Good question. So I've seen people try this, but you have to have very big deep pockets to change an entire neighborhood. So really on that slide, what we were trying to say is that it's a D class, but it's in a C or B class area. So that's and this particular one would be, I'd see a B class area because it's right next to the school, the high school, elementary school, high school, and then you've got that B class single family next door. So another good way to kind of differentiate a D to an A is look at the rent per square foot. That to me is the best sign to figure out what asset class it is, because we've got stuff in East Dallas that was built in the 80s. And if you did like a lot of folks do, is just take the year, you would think that's a B class. Well, most folks would not be found caught there in the daytime at those 1980s built properties. So those, in fact, would be a D class. So don't use year. I think the rent per square foot is the best way to show it, because that's basically take all the factors and tell you how desirable it is to live there.
Mm-hmm. Nice. That's good to know. That's awesome. So one of our attendees asked if you outsource your management or if you do your own property management, which you answered that question, but to kind of go a little bit deeper into that, have you always had your own in-house management? Did you get to a point where you said, hey, we're kind of large enough now, we need to do this? Tell us a little bit about that.
Sure. Yeah. So, basically every syndicator is going to have to start out with third-party management. It's kind of how you have to do it. I got frustrated about 3.5, 4 years ago with the third-party management companies we would have here that we've used in the past. But anyway, so I bought one. So I didn't start one from scratch. I think you're crazy if you start one from scratch. But I teamed up with a great guy and bought 49% of his company. So now we have that basically in-house. They're headquartered in Mansfield. I'm in Plano, so I try to stay away from the property management side. Let them do their thing. But it's a great way to have better control, and we've been able to really kind of pour the resources back into that management company. So we have some really high level kind of C-suite folks that run that for us.
Mm-hmm. Nice. That's awesome. Let's see. On the sale of these properties, is there a potential to 1031 the proceeds into another property?
That's a good question. And the word is potential, and we'll talk about potential. There's always a chance, right? You're telling me I got a chance. So there is a way to do that. We've never done it just because we've been able to use cost segregation, bonus depreciation to really make the 1031 very kind of ineffective. Now, bonus depreciation is going to start being supposedly now phased out by 2023. So ask me in 2 years how we change. But for now, we've been able to avoid 1031s by pouring our money back into new investments and using cost segregation to offset our capital gains as well. So there is a way to do it. 51% of the investor group at the time of the sale has to go into the next investment as well. So sometimes some of these, Rockefeller was a $9.8 million raise. So we had about 120 people in that one. Sometimes if you're trying to get 51% of anybody to do anything, it's a little bit like herding cats sometimes. So I wouldn't bank on that. I've seen it done once or twice in the 10 years by some colleagues, but it's not often done.
Mm-hmm. Nice. Yeah, that's a lot of investors, and it's literally herding cats sometimes. Let's see. This is a good question. How do you estimate your rehab budget capital? And if you underestimate, where do you raise more money?
Oh, good question. So we don't underestimate. That's the thing. So we've done this for so long that I'll walk on a property, we'll walk, 10% of the units. And the team walks more than that, but I'll go and walk 10% of the units, and I'll be within 5-10% of the rehab budget every time, just because I've done this for a long time now. But what we also did to keep better control is now we have our own in-house construction team. So we have vet construction, and we have them go out. They do due diligence for us. At the same time, they're getting bids for us on all the work. So we know going in within just a couple of weeks of our due diligence, we know basically what our rehab budget is going to be down to the penny, pretty much. So and then on top of that, we always throw some contingency. On our side, on the investment side, we always overraise to make sure we have that cushion in case we do have a curveball. Or again, another good example is we've got an Aclass here in town that's near a lake, and once we bought it, we got in there. There was like one or two residents came up and asked us if we would screen in their porch, and we were like, I've never seen that done before, but hey, we'll try it. So we overraised for that one, which is great because for $800 to screen in that porch, we're getting $75 more a month in rent. So that's a 1-year payback, better than a 1-year payback, and put a 5.5 cap rate underneath that. So massive gain. So that's kind of why we overraised for, those two reasons, for be on the safe side. And then if we can get creative and find new ways to continue to add value, then do that as well.
Mm-hmm. Nice. Those screened in porches can make a huge difference. We have a lake house and the lake bugs sometimes. Ooh, yeah, $800 well spent. Yeah. Awesome. We've got time for just a few more questions here. And this one, don't know how deep you want to get into this one, but I'll ask it anyways. Okay. How do you use cost segregation to eliminate a capital gain?
Oh, here you go. So I've actually, I'm going to have on our YouTube channel our CPA talk about this, but so again, where's the asterisk? We need an asterisk up here, Haley. Right. I'm not a CPA, so take this with a grain of salt. But this is a real live example that I personally did. It worked for me in my CPA. So talk to your CPA as well. But basically, I invested $100,000 passively into a multifamily fixer-upper in Atlanta. And in 3 years, I got back $184,000, right? So my profit in 3 years was $84,000 off $100,000 profit. Not bad, 84% gain over 3 years. I'll take it, right? So they did a great job on that deal. But that did leave me with what looked like a pretty hefty capital gain to pay on that. So what I did is I reinvested all $184,000 into one of our Cleveland, Ohio C-class cash flow deals. And we were able to, through cost seg, write off 50% of our initial investment in that same year. So because the sale and the purchase of this new investment happened in the same year, I was able to, on the Cleveland deal, write off $92,000 in capital gains and it offset investment income. And obviously that's more than the 84 I made on the Atlanta deal. And so that's how you do that. That's a beautiful thing, but you got to keep in mind, basically, you've got to keep buying real estate until you die. So you're on a treadmill to buy real estate until you die. That's what I told my CPA, and he said, absolutely, I'm right. So anyways, there's worse problems in the world, but if you've got to keep buying real estate, it's not too bad. But that's how you can kind of, at least today, protect some of your gains from capital gains tax.
Mm-hmm. Awesome. And you said on your YouTube channel, you have a video with a CPA who walks through that. What other types of educational content do you have on that YouTube channel? Maybe to kind of plug it for everyone out there.
Yeah, so really kind of cover it all. I'm kind of an investment nerd, so not just real estate. We're going to find some personal finance stuff in there as well. So we've got, we talked about the BRRRR method, but the BRRR method, but just for apartments. We do some property tour videos. So you can actually see properties that we've done. As well. So we're going to keep putting our third one out of that here pretty soon, but just tons of educational videos, and they range from some of that are real estate specific, and then some are kind of more of a personal investment kind of lens.
Mm-hmm. Nice. Awesome. So guys, be sure to go check that out. And I have one more question. I like this one. So big shout out to whoever asked this. If tenants barbecue and a fire wipes out 30% of the units and insurance doesn't pay for 3 months, rebuild takes 6 months, how do you stay afloat with low cash flow? Very specific question.
Man, I feel like this was like coming from from some experience, but that they maybe had. But so you've got so insurance will cover lost rent. So what they'll do is they'll take your usually last 12 months of occupancy. So say you were at 90%, and if you lost 30% of your units, they would pay you 90% of the lost rent on those that 30% of units that are down. So you should get that check pretty quickly. And the other thing too is with insurance, so I should back up. So I was voted in 3 times to save other sponsors deals in multifamily. One of those being that person really tried to get an extra $1 million on a roof claim from an insurance company through an adjuster. It was a complete mess, right? So what we do up here is we're very open, honest with our insurance companies, and I think they know that now. We work with them. They're very responsive. We've got a great insurance broker with Higginbotham. Shout out to them. And so we don't really have those issues of 6 months payouts, but you might if you did the adjuster route as well. So, and I'm sure you're going to get a flood of questions here, Haley, about why you should use an adjuster. I don't think you should. I think it wastes time and it detracts from your overall business plan. But that's me.
Nice. Which, speaking of, just out of curiosity, how did you guys fare in the freeze that we had in February? Did y'all have pipes burst in your units? How did y'all handle that? Just kind of because on a larger scale, it really affects a lot of things.
Absolutely. So our stuff here in Dallas Fort Worth actually was fine. It was more of our assets in East Texas, in the Longview, Tyler area, and then Oklahoma City. So we actually that Monday after the storm. We heard Home Depot, there's 2 Home Depots in town that we're going to get new plumbing supplies. So we sent our guys up there, bought out the store, shoved it in 2 different trucks, and one went north to Oklahoma City and the other to East Texas to drop off plumbing supplies. So, that's not our first kind of disaster we've had to do that with, but the first one was a big hailstorm we had and just blew out, probably 60% of the windows at a property and across a big city as well here in DFW. And so what we did is that next day I went up and I told our window guy, hey, I will pay you a check today. I will prepay for windows because I want windows first. And so we kind of learned from that thing because we basically had windows in 2 to 3 days where, the rest of the folks that waited, it was probably 6 to 9 months and they still had particle board up across their windows. So if you're able to buy and scale in bulk like we are, you can kind of head off that kind of stuff and make it a better living experience for your residents.
Mm-hmm, definitely. And it definitely helps to have those connections in the industry too. Someone you can call when you need that, right?
Right. That's exactly right.
Awesome. So Kenny, that about wraps it up for the questions here tonight. But before we sign off, do you have any last kind of closing thoughts or piece of advice for our attendees out there?
Yeah, sure. I guess the only thing I'd say is that inflation's coming, guys. So if you played the paper assets, like I hope you did in March and June of last year, I did, and it paid for my new Corvette. And then that was my goal for all of March through June. So check that box. That's done. But from now on, it's going to be hard assets that are going to be the winners because inflation's coming. With as much money they dumped into the economy. We're already seeing it in single family price homes, and here in Dallas Fort Worth, people are paying over appraisal. I mean, think about that. People are paying over appraisal and cash over appraisal. So inflation's coming. Hard assets, especially ones that cash flow, I think are going to be the best ones. So make sure you do your homework, but pick the right ones, and you'll do fine.
Mm-hmm. Awesome, Kenny. Well, thank you so much for joining us tonight. You had a lot of great information to share. So I really appreciate the in-depth technical look at both of these different types of assets. Guys, be sure to go check out his website. He's got a lot of resources for you there and that YouTube channel as well. And if you have more specific questions that we weren't able to answer here tonight, be sure to send him an email at info@wolfe-re.com. So Kenny, thanks so much for joining us tonight. I'm sure we'll see you at another one of our events, hopefully here in the near future.
Absolutely. Thank you, Haley, very much.
Awesome. Bye, everyone. Have a good night.
Bye. Oh, there we go.